This audiobook is written and produced by Wealth Books. Imagine unlocking an endless reservoir of capital, interest-free, relentless, and growing exponentially, powering every investment you make. Warren Buffett mastered this secret weapon, known as the insurance float, fueling Berkshire Hathaway's meteoric rise from modest holdings to a $1 trillion empire. Now, you'll learn how to harness the unstoppable force of compounding, measuring intrinsic value, guarding with a margin of safety, and allocating capital like a master, and ignite your own wealth revolution. Chapter 1. The Exponential Engine. Understanding Value Compounding. Michael Wong sat at his kitchen table surrounded by crumpled notes and financial blogs open on his laptop as he wrestled with a question that thousands of would-be investors pose every day. How can a small pile of cash transform into a mountain of wealth over the decades? He discovered that the secret lives in compound interest, a deceptively simple idea where you earn interest not just on the money you invest, but also on the interest you've already earned. To illustrate the difference, he ran a quick calculation. If you lock $1,000 at an 8% simple interest rate, you'll get $80 each year, and that's it. But let that same 8% compound annually. Suddenly, that $1,000 swells to over $2,100 after 10 years, without adding another dime. Michael's mind raced back to the legendary story of Peter Lynch, whose Fidelity Magellan Fund surged by over 2,700% between 1977 and 1990. In everyday terms, a $10,000 investment in 1977 would have exploded into about $280,000 by 1990, just by letting the gains keep reinvesting. Then there's Warren Buffett. He started investing at 11, saved his first $100, and never stopped. Buffett once called compound interest the eighth wonder of the world. The man wasn't joking. Most of his billions didn't show up until he was already past 60. Compounding doesn't care about fast. It only cares about long. And just to prove the power of time and patience, take this. If you'd bought just 2 shares of Coca-Cola back in 1919 for a total of $40 and reinvested every dividend, by 2012, those 2 shares would have turned into a jaw-dropping $9.8 million. Let that number sink in. Not through trading, not through some Wall Street wizardry, just patient, consistent reinvestment over time. Michael decided to break the magic of compounding down into 3 simple, do-now rules. Invest regularly, reinvest dividends, and stay patient. To test this out, he ran a little experiment. If someone invests $100 every month and earns a modest 6% annual return, they contribute $36,000 over 30 years. But the result? Nearly $98,000. That's nearly triple the money, and most of it comes from the compounding, not the deposits. He also picked up a tool called the Rule of 72. It's not a gimmick. You take 72, divide it by your expected annual return, and boom, you've got the number of years it'll take your money to double. So at 8%, your money doubles every 9 years. At 12%, every 6. It's not magic. It's math. But Michael learned there are enemies to this magic. Silent killers. One of the biggest? Fees. A 1% difference in fees doesn't sound like much, until you realize it can slash your total return by more than 240% over 30 years. That's the difference between retiring comfortably and still clocking in at the grocery store at 72. So Michael started favoring low-fee index funds and negotiated brokerage costs wherever he could. Another safeguard he picked up from Buffett, the margin of safety. It means you buy a stock at a price that's meaningfully below what you think it's worth. Say you estimate a company is worth $100 per share. You don't buy it at $98. You wait until it hits $70 or even $60. That buffer protects you if your calculations are off or if the market hits a storm. Michael's friend Sarah, a nurse who worked night shifts, learned this the hard way. She started investing by using a simple spreadsheet to estimate intrinsic value. She chose conservative growth assumptions and current dividends. One day, a stock she'd been tracking dropped below her target price by 25%. She took the plunge with just 10% of her portfolio. 5 years later, That single decision delivered an average annual return of 9%. Not flashy, but quietly powerful. Michael also got practical. He made a spreadsheet with 3 columns: date, contribution, and market value. He plugged in a compound growth formula, so the projections updated automatically. And for those overwhelmed by technical jargon like discounted cash flow models, he simplified things using a quick 2-cell version of the Gordon growth model. 1 cell for annual dividends, another for required return minus growth. Boom! Estimated fair value. Automation was the next step. He set up recurring deposits, enabled dividend reinvestment, and unsubscribed from stock-picking alerts and news noise. He automated reminders to review his holdings once per year, not every hour. Because compounding isn't about playing the market. It's about staying in it. He even built a checklist for busy professionals. Monday alerts when a stock hits his buy price. Quarterly dividend reinvestment confirmations. An annual bump in contributions by just 1%. All automatic. All painless. The biggest challenge? Compounding feels painfully slow at first. Years 1 to 10? Pretty boring. Then something clicks. Growth starts snowballing. By year 20, the numbers start looking surreal. By year 30, you wonder how you ever lived without it. Michael ended his compounding playbook with one final dare. Set up your first investment this week. Automate it. Reinvest everything. Ignore the noise. And promise yourself you won't touch it for a decade. Because once you unleash this exponential engine and get out of its way, your future self will thank you with compound interest. We hope you're finding this audiobook useful. Please give a like. It really helps. Thanks so much, and now back to the audiobook. Chapter 2. Hunting Intrinsic Value, the Seed of Exponential Growth. Intrinsic value is the calculated worth of a company based on its future cash flows rather than today's market price. Instead of chasing hot stocks or market fads, the value hunter screens for businesses trading at a discount to what they'll earn down the road. The first simple rule is to estimate free cash flows for the next 5 years using conservative growth rates tied to real sales and profit margins. If an industry is mature and competition is fierce, project cash flows growing at just 2 or 3% annually. Next, choose a discount rate that reflects business risk. Often today's 10-year government bond yield plus a 3 to 5 point buffer. Plug your projected cash flows and that discount rate into a spreadsheets and PV function. If you don't have Excel, Google Sheets offers the same tools, and free online templates can do the heavy lifting. Sum the present values and add a terminal value grown at a low perpetual rate, say 2%, to arrive at your intrinsic value estimate. Rule 2. Apply a margin of safety by targeting a purchase price at least 25% below your calculated intrinsic value. This buffer cushions against overly optimistic forecasts and sudden market shocks. One listener shared he refused to buy his favorite retailer until his model showed a 30% discount. That discipline saved him from double losses in the last downturn. He calls it his pre-mortem rule. If the deal doesn't work on paper, it isn't worth a single red cent. Rule 3 is a qualitative check. Review 5 years of management's capital allocation decisions to ensure leadership isn't underwater on past investments. Scan annual reports for commentary on acquisitions, dividends, and buybacks to confirm they respect shareholder capital. Bookmark each company's investor relations page. Those transcript and slide archives often reveal unfiltered strategy discussions that spreadsheets can't capture. Rule 4. Cross-check valuation ratios like PE, PB, and EV/EBITDA against industry peers to spot genuine bargains, not value traps. If a stock trades at a lower PE than rivals yet boasts stronger free cash flow margins, you might have discovered a hidden gem. One seasoned investor doubled his position in a manufacturing firm after noting its P/B ratio sat at 0.8 versus competitors at 1.5, an early signal of overlooked value. Rule 5 warns of common valuation pitfalls. Avoid hard-coding overly optimistic growth or ignoring terminal value sensitivity. Run a worst-case scenario by having your growth rates. If that conservative model still shows a 15% upside, You have room to stay invested even if business slows. Rule 6 champions simplicity. Don't build 100-line formulas. Focus on key drivers: revenue growth, operating margin, reinvestment rate. Shorter models are easier to audit and less prone to hidden errors that can derail analysis when real life deviates from your assumptions. Rule 7 encourages ongoing maintenance. Update your thesis quarterly. If sales growth or margins shift materially, your margin of safety will flex accordingly. One investor sets calendar alerts in a spreadsheet to revisit DCF inputs after each earnings season, avoiding buried-in-noise reviews. Rule 8 stresses patience. Intrinsic value hunting isn't a sprint, but a trek. The best opportunities may require months of screening and stalking before they appear at the right price. When anxiety creeps in, recall the engineer who checked daily quotes for 6 months before spotting a 40% discount on his favorite utility stock. His diligence yielded triple returns as the market finally recognized the company's hidden cash flow strength. Rule 9 suggests visual simplicity. Color code key cells and use clear labels so your spreadsheet remains intuitive. Visual clarity reduces errors and keeps you disciplined during market euphoria when assumptions can get stretched. Rule 10 invites you to learn from others, but verify everything independently. Follow seasoned value investors' blogs and podcasts, then reverse engineer their public spreadsheets to master conservative forecasting. Finally, treat your intrinsic value model as a living document, not a static prediction. Update it when you uncover new information or industry shifts. By following these 10 practical, step-by-step rules, you'll gain the confidence to hunt intrinsic value like a pro and let compounding work quietly in the background. Every great bargain you identify adds a new cornerstone to your compounding fortress, brick by brick, year after year, paving your clear path to long-term wealth. Chapter 3. Deploying the float. Harnessing other people's capital. Imagine Sarah, a mid-level manager in a mid-sized city, poring over her monthly statements and realizing she's been holding $5,000 in her high-yield savings account, earning a paltry 1.5% while the stock market hums at 8% annual gains. One evening, she stumbles on a story of Warren Buffett using insurance premiums, money paid by policyholders he holds for months or years before claims are due, to invest in Coca-Cola and seize candies at rock-bottom prices. She learns this float behaves like an interest-free loan. The longer Buffett holds it without paying out, the more capital he has to deploy, compounding returns far beyond what his shareholders might reach on their own. Intrigued, Sarah decides she can build her own float. First, she inventories every credit line she can legally and responsibly tap. She has a brokerage margin account with a $10,000 margin loan at 2%, a 0% intro APR credit card for 6 months, and a home equity line of credit at 4%. She treats each as a form of float, capital she controls now, to invest today, as long as she pays it back before the low-cost window closes. She sets calendar alerts. 2 months before her credit card's promotional APR ends. 6 months before the home equity line's draw period closes. These reminders become her guardrails, preventing costly surprises. Next, Sarah assesses the true cost of each float. She calculates the margin interest at 2% subtract from her expected market gains of 8%, leaving a net 6% benefit. The home equity line at 4% paired with stock returns still nets 4%. Even the credit card's promotional 0% yield means she's effectively borrowing free, but only if she pays it off on time. By comparing these to the yield on her idle savings, 1.5%, she realizes each borrowed dollar can meaningfully amplify her compounding snowball. But capital isn't truly free. Sarah builds a simple worksheet. Column A lists each credit facility. Column B notes available limit. Column C records the interest rate. Column D calculates net expected return, projected market return minus rate. She highlights any net gain below 3% in red. She decides to avoid leveraging those. This one-page float dashboard sits atop her desk, an ever-present guide. Armed with this roadmap, Sarah allocates $3,000 from her intro APR credit card into a basket of 3 undervalued dividend reinvestment stocks she's researched: a utility with steady cash flow, a tech spinoff trading below book value, and a consumer staples name riding out temporary logistics hiccups. She programs dividends to slip straight back into her brokerage, compounding automatically. Should the stock market deliver 7% annually, her zero-cost loan makes every dividend dollar a bonus. Meanwhile, she channels $5,000 of her margin line into a small-cap value ETF known for 10% annualized returns over the past decade. She knows margin amplifies losses as well as gains, so she caps this allocation at half her margin limit and sets a stop-loss rule. If her ETF position falls 15%, she'll liquidate to prevent deep drawdowns eating into her principal. Sarah's best insight comes from a painful lesson. 2 years ago, she tried the famous 0% balance transfer trick without setting reminders, and her promo period vanished unheeded. Suddenly, the remaining balance tacked on a 19% APR that shredded her returns. Swearing she'd never repeat that mistake, she programs automated payments to wipe any card balances 10 days before promotional windows end. She also reviews each statement on the 1st of every month, making float management as routine as her morning coffee. As her portfolio grows, she refines her strategy. She spots that her utility holding yields 4%, so after dividends, she enrolls it in a dividend reinvestment plan at her brokerage. No commission fees, just straight reinvestment. She watches as every quarterly payment buys incremental shares, each funded by borrowed dollars she carefully ensures stay within her low-cost thresholds. Toward the end of the year, Sarah totals her float-funded investments, $8,000 in stocks and ETFs, all leveraged at rates between 0 and 4%. She projects, conservatively, that her compounding gains net of interest will add 5% to her overall portfolio returns next year. That extra float bump could mean an additional $400 in profit, money she wouldn't get if she left her savings idle. Finally, Sarah applies Buffett psychology. He treats float like sacred capital. Never gamble it on speculative ideas. Always deploy it with a long-term margin of safety, and never let float obligations outrank the health of the underlying business. Sarah borrows only up to levels she's comfortable paying back without stress, prioritizes high-conviction value opportunities, and keeps a 3-month cash reserve to meet any margin calls. In essence, she transforms other people's capital into her private compounding engine, one that's disciplined, low-cost, and built on clear rules. By turning an everyday credit line into a strategic tool, Sarah's learned that float isn't a mystery reserved for insurance giants. It's simply capital you control, temporarily entrusted to you at a known cost. Handled with respect and strict processes, float becomes the secret accelerator under your compounding engine, lending turbocharge to every dollar you invest. We hope you're enjoying this audiobook. Consider subscribing to the channel if you haven't already. It really helps. Thanks so much, and now back to the audiobook. Chapter 4. Margin of Safety, Buffering and Feeding Your Compound. Imagine you're building a skyscraper on shaky ground. You wouldn't stack steel and concrete directly onto sand. You'd lay a deep, reinforced foundation first. In the world of investing, the margin of safety is that foundation, a deliberate gap between what you think an asset is worth and what you actually pay for it. Without that cushion, a single market tremor can crack your entire structure and stop your wealth building in its tracks. Take Maria, a young analyst hungry to prove herself. She ran her discounted cash flow model on a bank stock in late 2007 and arrived at an intrinsic value of $55 per share. But driven by excitement, she bought at $50, giving herself a slim 9% buffer. When the financial crisis hit, the price plunged to $15, wiping out her entire stake and leaving her nursing regrets for years. If she'd insisted on a bigger gap, say 30%, she would have either avoided the stock entirely or had enough of a cushion to ride out the storm and buy more at bargain prices. Contrast that with Alan, a seasoned investor who eyed a resilient consumer goods company trading at $32 while his conservative model pegged it at $50. By insisting on a 36% discount before pulling the trigger, he not only shielded his capital when the 2008 crash arrived, but also snapped up extra shares near $28. Those additional shares, purchased when most panicked sellers fled, generated dividends reinvested into the same stock. Over the next decade, his compounding snowball roared forward, fueled by the very volatility that felled Maria. How can you adopt this approach without overcomplicating your process? Start with 3 no-nonsense rules. Anchor your estimate conservatively. Forecast free cash flows for 5 years using conservative growth rates, never the best-case scenario. Apply a prudent discount rate that reflects real-world risks. For terminal value, assume modest long-term growth that barely outpaces inflation. This builds a lean, durable intrinsic value you can trust even if conditions worsen. Demand a 30% gap. Once your model spits out a fair value, subtract 30% before you even consider buying. If your stock is worth $100 on paper, you don't touch it unless it trades at $70 or below. That 30% gap is your shock absorber for earnings misses, recessions, or executive scandals. It turns market drops from oh no moments into aha buying opportunities. Automate discipline. Let your brokerage platform do the watchful eye for you. Set automatic alerts for your 30% discount price instead of refreshing charts all day. Schedule a weekly check-in. No more, no less. To review notifications, update your models, and decide calmly whether to act. This keeps emotions at bay and prevents you from chasing green candles or fear-driven red ones. Identifying pain points. Many investors freeze when markets wobble or chase headlines when momentum surges. The margin of safety rule solves both. When the market rallies beyond your threshold, you walk away knowing you didn't overpay. When it plunges, you gear up to buy at prices your future self will thank you for. No more agonizing over short-term noise. For an extra layer of assurance, backtest your margin. Grab 5 years of monthly price data for the type of stock you're eyeing, whether it's a utility, tech disruptor, or consumer stalwart. Measure the worst peak-to-trough drop during that span. If your 30% buffer still leaves you above those historic lows, you've built real resilience into your process. If not, consider widening your gap to 35% or even 40% until you cover past pain points. Here's another practical twist. Pair your margin of safety with dollar cost averaging when volatility spikes. Suppose a stock dips from $70 to $56, your buy threshold. Instead of deploying your entire allocation at once, split into 2 equal parts. Buy half at $56 and set a second alert at 10% below, around $50. This staggered margin approach can smooth entry pricing and safeguard against multiple rounds of bad news. Remember, the margin of safety isn't a pessimistic mindset. It's a strategic advantage. It turns every market setback into a chance to top up your compounding engine on sale. By buffering first, you protect your principal. By feeding your compound at discounted prices, you turbocharge long-term growth. Over years and decades, those disciplined moves snowball into meaningful outperformance. In the end, investing without a margin of safety is like tightrope walking without net. You might make it across once or twice, but the odds aren't in your favor. Lay down that reinforced foundation, insist on your buffer, and let time and compounding do the heavy lifting. Your future self will thank you for every mile of dirt road you navigated safely, with your skyscraper of wealth standing tall on a rock-solid base. Chapter 5. Concentrated Bets. Sharpening the Compound Blade. Imagine you're at a crossroads with 2 portfolios in front of you. One is a sprawling garden of hundreds of plants, each getting a little water and sunlight. The other is a carefully tended row of 5 mighty oak saplings. Which would you check every morning? Which grows into a forest first? Value investing works the same way. Focus on your strongest ideas, water them deeply, and watch compounding work its magic. First, let's tackle why a handful of high-conviction picks can outperform a scattered collection of dozens. When you spread your attention across too many stocks, you dilute your ability to truly understand each business. It's like trying to master 10 languages at once. You'll end up fluent in none. But when you zero in on 5 to 10 companies you really believe in, you dive deep. You know their business models, management teams, competitive edges, and potential pitfalls. That level of intimacy turns uncertainty into confidence, letting you stick with winners through rough patches rather than panic selling at the first downturn. John, a retail investor friend, learned this the hard way. He once held 40 stocks across tech, energy, retail, and healthcare, thinking diversity would shield him. When the energy sector swooned, his allocation there dragged the whole account down. After a wake-up call in 2018, he pared his list to 7 businesses he could explain to his grandmother. He'd spent nights reading annual reports and talking to customers in online forums. By 2022, those 7 names outpaced his old, sprawling portfolio by 30%. The secret? He understood the business drivers so well he never wavered when headlines got bleak. So how do you build a concentrated watch list without turning it into a gamble? Start with a rule of ultimate upside. Ask yourself, if this company thrives, could it double or triple in value over 5 years? If the answer is yes, that's your first filter. Next, apply a margin of safety checkpoint. Is the current price at least 20% below your conservative estimate of fair value? If a business checks both boxes, big upside and a buffer, you've found a candidate worth serious weight. Weighting matters too. Don't just give equal dollars to each pick and call it a day. Instead, rank your list by conviction level on a 1 to 5 scale. Your top 2 ideas get 20% of your capital each, mid-conviction ones get 10 to 15%, and the rest fill in with 5 to 10%. This way, your biggest winners have enough fuel to pull overall returns higher while still leaving room for surprises. Actionable tip. Carve out a simple spreadsheet column for each stock's conviction score and another for position size. Update these scores quarterly based on new data, earnings surprises, management changes, or shifts in market share. If a company you loved misses guidance twice in a row, it might slip from a 5 to a 3, trimming its weight a notch. Conversely, if it beats expectations and reveals a new product poised to dominate its niche, bump it up and beef up your allocation. Now, let's tackle one common stumbling block: fear of concentration risk. What if one big position goes bust and drags you down? The antidote is rigorous due diligence. For each stock, list out the top 3 what-ifs that could send its share price plunging: regulatory setbacks, major customer loss, or a disruptive competitor, and assign each a probability and potential impact. If the numbers make your heart race too fast, size the position accordingly. But don't let hypothetical unicorns of doom keep you from owning outstanding businesses that history shows are far more likely to thrive than to vanish. Sarah, another investor we know, used this framework in 2020 when she fell for a small-cap biotech with a promising cancer therapy. She ranked her conviction high because clinical data looked solid, priced a 25% margin of safety, and capped her position at 12% of her fund. When the trial hit a safety snag, she didn't panic sell. She'd already modeled the downside, and she knew even a delay wouldn't destroy the company's core value. A year later, after a successful Phase 2 readout, her biotech stake soared 4 times, becoming her top performer. Finally, carve out a ritual to keep your concentrated portfolio honest. Every quarter, host a 10-minute CEO session with yourself. Bullet point the latest developments, reaffirm why you own each stock, and ask, would you buy more at today's price? If the answer is yes, set a small limit order to top up. If no, schedule a review for next quarter rather than slamming the sell button amidst market noise. Concentrated betting isn't reckless gambling. It's a disciplined approach that sharpens your compound blade. By focusing on your best ideas, weighting them by conviction, stress testing downside scenarios, and updating your thesis regularly, you give your portfolio the power to grow exponentially. Remember, a few well-tended oaks will always make a denser forest than 100 scattered saplings. If you're finding this audiobook useful, please give it a like. It really helps. Thanks so much, and now back to the audiobook. Chapter 6, Dividend Reinvestment, the Silent Co-Pilot. Investing is often sold as a race to pick the next hot growth stock, but Sarah learned early on that the quiet hum of dividend reinvestment can outperform flashy momentum plays. On a crisp February morning 5 years ago, she sat at her kitchen table staring at her brokerage statement. Her modest Coca-Cola position had quietly doubled in value, and nearly half of that gain came from reinvested dividends. In that moment, she realized dividends aren't cash you spend. They're fuel you pour right back into the engine. Imagine you own 100 shares of a solid dividend payer yielding 3% annually. Instead of pocketing that $3 per share, you automatically buy more shares the moment dividends arrive. In year one, you get $300, which buys 5 extra shares at $60 each. Next year, those 5 new shares generate their own dividends, adding another $9, and so on. This snowball of reinvested dividends can add an extra 2 to 3 percentage points to your annual return, silently compounding alongside price appreciation. So how does someone turn this silent co-pilot into a roaring ally? First, identify your dividend champions. Look for companies with a track record of increasing payouts for at least 10 consecutive years, so-called dividend aristocrats. These firms tend to be mature and cash-generative, able to weather slow patches without cutting payments. Utilities, consumer staples, and leading healthcare firms often fit the bill. But don't chase yield alone. An 8% payout that disappears next year won't help you. Focus on sustainable yields in the 2 to 5% range, backed by payout ratios below 60% of earnings. Once you've selected your holdings, enroll in a dividend reinvestment plan, or DRIP. Most online brokers offer this feature for free, no commission, no fuss. When dividends hit, the plan automatically buys fractional shares, so every cent works for you. If your broker doesn't support fractional shares, choose a low-fee platform that does. Every fraction counts over decades. For example, Marcus switched from a traditional brokerage to a fintech app that reinvested dividends into fractional shares the day they arrived. He found his small, incremental purchases added up faster than he ever expected. Next, automate monthly or quarterly reviews. Sarah blocks the first weekend of each quarter, January, April, July, October, to glance at her dividend activity. She tracks 3 numbers: total dividends received, shares acquired through reinvestment, and yield on cost. This last metric shows her actual dividend yield based on her original purchase price, not the fluctuating market price. When her yield on cost climbed from 3% to 5% over 3 years, it reinforced that dividends, left alone, drive growth without her lifting a finger. But real-life investing throws curveballs. In 2022, when Bank of America cut its dividend from 0.7% to 0.4%, Marcus's automatic plan bought fewer shares than usual. Instead of panic selling, he viewed the dip as an opportunity. He manually topped up his position when shares fell 15%, then watched both his dividend yield and share count rebound. The lesson: stay calm, stay invested, and use market dips to your advantage. For those worried about concentrated risk, diversify across sectors. Sarah holds 7 dividend payers, 2 in consumer staples, 2 in healthcare, 1 in real estate investment trusts, 1 in utilities, and 1 in technology with a modest payout. This mix smooths her cash flow and ensures a downturn in any one sector won't derail her compounding. She also caps any single position at 20% of her dividend portfolio, so no one company can overwhelm her returns. Finally, set projections, but don't obsess over them. Open a simple spreadsheet with columns for year, starting share count, dividend per share, dividends received, shares purchased, and ending share count. Plug in conservative dividend growth rates, say 5% per year, and watch the compounding curve unfold. Sarah did this in year 1 and saw her projections match real results within 10% by year 3. That small spreadsheet became her motivational dashboard, reminding her that consistency beats timing. Here's your step-by-step playbook. Pick dividend growers. Target firms with 10-plus years of payout increases and sustainable yield. Enroll in a DRIP. Use a broker offering free, automatic reinvestment into fractional shares. Quarterly check-ins. Track dividends received, shares added, and yield on cost. Seize dips. If a staple cuts payouts temporarily, consider topping up at lower prices. Diversify. Hold payers across 4 to 7 sectors, capping any one at 20%. Project the Snowball. Use a simple spreadsheet to visualize 5 to 10-year compounding. By consistently reinvesting dividends, even the smallest portfolios can transform into formidable compounding machines. Sarah's $5,000 stake in Coca-Cola grew to $12,000 in 5 years. Nearly two-thirds of that gain fueled by reinvestment, not market price alone. That's the silent co-pilot at work. Always there, always buying, always compounding. Embrace dividend reinvestment today and let your investments do the heavy lifting long after you've moved on to the next chapter. Chapter 7. Tax Advantage Compounding. Keeping the snowball uninterrupted. Sheila sat at her kitchen table one Sunday morning, sipping coffee as she scanned her investment spreadsheet. She had built her portfolio over years, but taxes were quietly nibbling away at her gains. She realized that even a modest 20% tax bite on dividends or capital gains could turn a roaring compounding engine into a sputtering engine on a long road trip. This chapter shows how to lock in every dollar of growth by using the right accounts and strategies, so your snowball never slows down. First, know your arenas. There are 3 main battlegrounds: tax-deferred accounts like 401k, and traditional IRAs, tax-free havens like Roth IRAs and Roth 401ks, and plain vanilla taxable accounts. Each has its own rules, costs, and benefits. Jack, a mid-career engineer, used to stash all his assets in taxable brokerage accounts until a mentor walked him through asset location principles. By shifting dividend-paying stocks into his Roth and high-growth tech names into his taxable account, he slashed his annual tax drag by nearly 1.5%, adding thousands more to his compounding snowball. Next, master the art of the Roth conversion ladder. Imagine Ricardo, a graphic designer in his early 40s. He didn't qualify for a Roth IRA direct contribution because his income spiked, but he still wanted tax-free growth. He opened a traditional IRA, contributed the annual limit, then promptly converted that money to a Roth IRA before any growth occurred. By paying tax on the small contributions rather than the future accumulated gains, he guaranteed that every penny left in the Roth would compound tax-free forever. Meanwhile, don't overlook the savior of matching, the employer 401k match. Sarah worked at a nonprofit that matched 5% of her salary. She nearly skipped the 401k because she disliked the fund options. After crunching the numbers, she realized that this match was an immediate 100% return on her contribution. She maxed out the match first, then funneled excess savings into her Roth IRA. In practice, that meant $2,400 free money each year, which grew tax-free in her Roth account and supercharged her compounding engine. Now let's tackle dividends versus bonds. Bonds generate interest that's taxed as ordinary income, often at higher rates than long-term capital gains. Greg, a cautious retiree, held corporate bond funds in his taxable account, only to watch 30% of his interest vanish to taxes. A quick pivot moved those bond funds into his traditional IRA. He then filled his taxable account with low-yield, tax-efficient index funds that produce minimal taxable distributions. The result? More of his returns stayed invested, rather than slipping out the back door. 4 high-growth stocks that rarely pay dividends. Prioritize them in your taxable account. Since they don't trigger yearly tax events, you get free compounding until you sell. Transfer them into your traditional IRA or 401k only if you need the space for more tax-inefficient assets. This simple rule of thumb, bonds and dividend stocks in tax-sheltered accounts, growth stocks in taxable, cuts complexity and keeps your after-tax returns humming. Next up, municipal bonds for taxable accounts. Lisa, a school teacher, wanted safe income but hated the tax hit. She discovered that high-quality municipal bonds pay interest that's often exempt from federal and sometimes state taxes. By swapping out her corporate bond ETF for a muni bond ETF in her taxable brokerage account, she boosted her net yield by about 1%, allowing her to reinvest more each quarter without any extra tax drag. Don't forget about tax loss harvesting. When Michael's favorite value stock dropped 15%, he didn't panic. He sold enough shares to realize a loss and immediately bought a similar ETF to maintain market exposure. That loss offset some taxable gains elsewhere, effectively giving him a small refund check from Uncle Sam each April. He then plowed that refund back into his portfolio, accelerating his compounding machine without skipping a beat. Finally, keep an annual tax check calendar. Choose a quiet weekend in December to review your account balances, projections, and potential opportunities for conversions or harvests. Set 3 reminders. 1 in January to max out tax-advantaged accounts. 1 in June to reassess your Roth versus traditional contributions based on year-to-date income. And 1 in November to plan any last-minute tax loss harvesting or Roth conversions before year's end. This regular cadence turns tax strategy from a chore into a seamless part of your compounding routine. By treating taxes as an integral part of your compounding plan rather than an unavoidable nuisance, you ensure that every dollar you earn stays invested for as long as possible. Whether you're a fresh graduate just opening your first Roth IRA or a seasoned saver juggling multiple tax buckets, the principles remain the same. Put the right asset in the right account, leverage every tax edge available, and schedule regular check-ins. Do that, and you'll keep your Snowball's gears greased, your compounding engine roaring, and your long-term goals well within reach.